Good afternoon. My name is Snyder, and I'll be your moderator today. At this time, I would like to welcome each and every one of you to the webinar on Does Value Investing Generate Alpha, conducted by Dr. Vikas V. Gupta, Head of Research and Product Development, Arthveda Fund Management Company. He has over 20 years of work experience in research, strategy, and operations. Formerly served as a professor at IIT Kharagpur and the University of California. He has a B.Tech from IIT Bombay and has earned a master's and doctorate from Ivy League University, Columbia University, New York. He has co-authored a book on corporate governance as well. In line with his philosophy of value-oriented investment and focusing on maximizing returns, he is going to present today on the topic, Does Value Investing Generate Alpha? After the speaker's presentation, there will be a question and answer session. We request each and everyone to identify yourself before you ask a question. Dr. Gupta, please go ahead. Over to you.
Thank you, Snyder. Welcome, friends. Today we'll discuss a topic on does value investing generate alpha, the academic and empirical evidence. We'll go very briefly. This is a presentation for the layman as well, so we've not spent effort on explaining a lot of things and going deep into details. But you'll get an idea of what we are talking about and what is the logic behind value investing and how it generates alpha. The modern finance theory, which includes the efficient market hypothesis, the capital asset pricing model, modern portfolio theory, etc., put together, has certain assumptions, and basically those assumptions say that one cannot beat the market, which means that alpha cannot be other than 0. Okay, so according to the efficient market hypothesis, alpha is 0. What are the assumptions behind that? The assumptions in the efficient market hypothesis is that all the information about a security are embedded in its market price. So all securities are priced at the appropriate values, and all the information which is available has been used by rational investors to calculate the appropriate value, and it has been priced to that. So that is the assumption of efficient market hypothesis. And if you want better than market returns, then you have to increase your risk exposure. And risk is defined by something called beta, which is based on the volatility of a particular security, relative volatility to the market. And if you want more returns, you have to expose yourself to greater risks or securities which have a higher beta, which means which are more volatile than the market as a whole. So the conclusion is that alpha generation is impossible. The expected value of alpha in an efficient market is absolutely 0. We'll look at the capital asset pricing model. This was born out of 3 papers. Of course, there is a lot of other research, but these were the 3 prominent papers by Sharpe in 1964, Lindner in 1965, and Fisher-Black in 1972. These 3 papers put together is considered the asset pricing model. Okay. Now, why do we say that the CAPM is still born? Because according to CAPM, alpha should be 0, but the evidence is that low PE stocks outperform the markets. And this evidence was available way before the 1960s. There was a lot of research done during the 60s itself while the capital asset pricing model was being developed. And post that also there has been a lot of evidence on this factor. And that's why we are calling it. So while there was a group of people building a model, at the same time there was another set of a number of researchers who were generating evidence which was contrary to this theory. And all of this was being researched, being presented, but a very prominent and authoritative paper by Farmer and French, who themselves were key people in developing the modern financial theory. They themselves went through the evidence in 1992 and came up with the paper, the Farmer and French 1992 paper, which goes through a lot of the previous work done during 70s, 80s, 60s, etc. And it also presents their new findings, and that clearly showed that the low price to earning stocks outperformed the market. Now naturally, according to the CAPM theory, it should have been because whatever gives you high return is obviously risky. So they tested it for beta, and it worked out the risk was actually lower for these stocks. So these were high return and low risk stocks, which was contrary to the theory. And so that is why we question whether CAPM is the appropriate theory in the first place. Okay. Now you look at what is value investing. Value investing, all this research which has been reviewed in 2011 by Ling and Koo. So it's a very recent paper which reviews most of the major studies of mechanical testing done by various researchers across various international markets, including the US markets. Okay, and the factors are things like low price to book value, low price to cash flow, low price to earnings, low price to sales, dividend yields, high dividend yields, etc. So all of these studies clearly show that the bottommost decile, which means the lowest price to book value, beats the highest price to book value, and this beats the market. Okay, and several other strategies exist. These are just the mechanical testing strategies which are applied on large databases. Okay, and the results are still coming after about 5 decades, and still those returns are maintained. So they are not getting arbitraged away, even though that is available, that information is available to a lot of people. So what do the modern financial theorists do? They co-opt the contrary evidence. If you can't beat them, you join them. So Farmer and French in 93 came out with a paper which basically said that since the volatility based beta is not sufficient to signify the risk involved or to explain the returns, there must be some other hidden factors which are signifying the risk. So the high return they maintain still is because of high risk, but we don't know what is that risk. So let's look at the other factors. And basically all the strategies of coming out with market beating strategies were labeled as factors which explain higher risks. So the risk model became beta, the new beta or the risk factor became a linear model of volatility, low price to book value, small capitalization, and momentum. And momentum was added by Carhart in 1997. So this became the 3-factor and the 4-factor models. 3-factor and the 4-factor models. Okay. So now what is happening, if you step back and think about it, they are able to explain it away, but they are not able to understand why the returns are happening. You are starting with the assumption that high returns are coming out of high risk. Since the results actually showed you that that's not the case, that the high returns are coming out from the low risk stocks, so you turn around and look for other factors, and now you say those are the risk factors which explain the high returns. So you're always maintaining that the high risks are driving the high returns. So in future, again, if someone comes with a strategy which even with this 3-factor or 4-factor model still beats, still has unexplained returns, then again someone will come up with one more factor to add, and hence this axiom of high risk, high return will always be maintained. The problem in this is that it's not a theory. Okay, any scientific theory has to be falsifiable, which means you should be able to prove this false. Now, if you go through this process, you can never prove this theory false, because you can always come up with one more factor to explain it. Okay, so that's why this theory doesn't stand. Okay, now we'll move to some empirical evidence on before that we'll move to a thought experiment, and then we'll move to empirical evidence which is available of beating the market. Okay, so this is a very famous discussion by Warren Buffett, and this was actually at the 50th anniversary of